Namaskar and a very good evening. Last 12 months has been extremely exciting in the currency markets because US dollar has been on a rampage. What led to this rampage? Because the US central bank has been hiking rates incessantly from 0% to 5% now because they are trying to combat very high inflation in America, which has surged to a 40-year high. Now, because of this, a lot of money has moved from the emerging markets and other markets into the U.S. debt market because of the high interest rates, because they are going to get a higher return, and that has caused the dollar appreciation against almost all currencies, barring a few. Now, when we look at the top 26 currencies in the world and rank their performance against the dollar, we find that on average, the currencies have depreciated by 5%, whereas the Indian rupee has depreciated a little more than 7.5%. That means Indian rupee is a slight underperformer. But interestingly, when we compare the relative volatility of the Indian rupee against the same 26 currency pairs, we find that the USDINR has been the least volatile currency pair in the world. So that means, in spite of the rupee's depreciation, which has happened because every other currency in the world has depreciated, RBI's intervention, that is buying and selling of dollars in the spot and the forward market, has ensured that volatility stays low. Now, why volatility needs to be low? Because when volatility is high, it becomes problematic for businesses to do various kinds of operations. Because if you don't know where the currency will be 6 months from now, 1 year from now, it can be 20% up or 20% down. Then it becomes difficult to conduct businesses, to do exports, to do imports. It becomes also difficult for economists to do forecasts, policymakers to frame policies. For households, it's also negative. So, all in all, a highly volatile currency is negative for the economy. So, by keeping the volatility low, it has a positive impact on the economy. It is also very important from the perspective of foreign investors, because if the currency becomes too volatile, then it becomes difficult for them to have an expected ROI on their investments, and it can slow down the flow of foreign capital into India. So that's the reason why RBI has been repeatedly talking about keeping volatility low in the currency market, and they ensure that by intervening on both sides of the market. They buy and sell. They have phenomenal amount of reserves, 600, close to $600 billion, and with that kind of massive reserves, they intervene on both sides of the market, not just on the spot, on forwards, on futures, on NDF as well. So that ensures volatility stays low. So the question now is, what's going to be the path forward? Now, one thing is for sure, that after a phase of high volatility in, just not in the USD INR, if we are looking about at the currency market in general, the last 12 to 18 months has been highly volatile, right? When I talked about low volatility, I talked about relative volatility, that is in the USDNR compared to other USD pairs. But when you are talking about the absolute level, currency market and every other asset class has seen phenomenal volatility over the past 18 months due to the interest rate hikes by the Fed, due to the Russia and the Ukraine war, etc. So it has been seen that volatility tends to come down in the ensuing period after highly volatile period. And also, last 12 months has been about central bank interest rate hikes. Now we are expecting, because of a global slowdown and lower inflation, interest rates are going to come down. So when interest rates tends to come down, especially led by the US central bank, we have seen that volatility tends to come down as well in the currency market, in the other asset classes, which means over the next 12 months you could actually see a lower volatility across currencies. But the question is, which way the USDNR will move. Now, if the US interest rate cuts happen from second half of this year, that is 2023, which the market is anticipating, then we could see a dollar weakness, which means the Indian rupee can strengthen against the dollar, and we could see a move towards 80 levels. But at the same time, we need to be aware of the geopolitical risks over the horizon. There are the flashpoints like the China and Taiwan and other places. So if any of those flare up, or the war efforts in Ukraine escalate, it can have a negative spillover on emerging market currencies, which means that EM currencies can see higher volatility and higher depreciation. So, with that in mind, assuming no such thing will happen, interest rate cuts from the Fed can lead to a situation where emerging market currencies can see some appreciation. So, with this, I conclude this short video. Thank you for watching it.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.